Got me falling right back.
So today I'm going to be interviewing none other than Andy Lara. He's a good friend of mine, lender, has been a lender for over 18 years. And actually, I purchased a property last year. He did my loan. My dad just moved out to Agua Dulce. He did his loan. And he's a person that takes much pride in what he does. And, introduce yourself, Andy.
Andy Lara. I work with MMC Lending. I've been with MMC for about, 12 years.
Mm-hmm.
12 years. I started in the industry in 2004. That's when I got licensed with the state of California in 2004. And I've only actually worked for two banks. First Security Lending in Burbank, and then when it hit the fan in 2008, I moved over to MMC Lending.
Got it. And what got you into the business?
I had a family member that introduced me to lending. Before I was doing this, I was a paramedic in Kern County, which I love. I love medicine. But then, I was kind of sort of killing myself there. And when I closed my first transaction, I decided to move over to lending.
Got it.
Yeah.
Beautiful. So this is going to be a mixture of kind of information for the consumer, people that we serve on an everyday basis, but at the same time, there's some agents that don't know the answers to these questions, right? So some are going to sound kind of trivial, and then others are going to be a little bit more in depth, right? Mm-hmm. And then at the end, I'll give you a chance to kind of add anything that you say, Jerry, you didn't talk about this, and this is something that I see as either a big concern or people don't really know about it, and I want to expose it to more people, right? So, number one, why is getting pre-qualified important throughout the home buying process?
Yeah, it's super important because, first of all, you need to know exactly how much you qualify for. You need to know what your mortgage payments are going to be. You need to know how much money you're going to come in with, right, for your down payment, your closing cost.
Mm-hmm.
Because if you're out there looking for houses and you fall in love with something, and then once you open escrow, or not that it would happen, but if you were to open escrow and you don't qualify, that's gonna be that's gonna hurt. So it's always better to know before. And of course, you realtors, you need the pre-qual letter, the DU approval, the credit, and the assets. And that's I'll be the one that will be sending that stuff to you guys.
Got it. Okay. Now, what documentation is needed to get pre-qualified?
So I definitely need all income documentation whenever we're doing an FHA loan or a conventional loan. Mm-hmm. So tax returns, W-2s, pay stubs. For pay stubs is 1 month of pay stubs. Tax returns is 2 years. W-2s is 2 years. Bank statements, 2 months of bank statements. There's other non-traditional loans that I can do. Mm-hmm. And that just opens a big realm in the lending industry. But I will be, talking to the client and seeing if we're able to offer those. Those are bank statement loans, P&L loans.
More non-traditional.
Non-traditional loans. So there's other stuff that we can do, but definitely the first four that I mentioned.
Got it. Now, should a client, let's say I'm a consumer, I have some credit cards, I haven't filed my taxes just yet. Should I run over, pay my credit cards, go file my taxes first, and then see you? Or what should I do?
No, I think you should come and see me first. And the reason behind that is that a lot of people have this conception that if they have like $10,000 worth of credit cards, mm-hmm. that they're not going to be able to buy. But in the lending industry, we don't look at the full amount of what you owe. We look at your monthly payment. So sometimes your payment is like $90 or $120, and it doesn't really affect your purchase power. So yeah, don't do that.
And what is that ratio called?
That ratio is called the debt to income, which I'm sure we can talk about it a little more. Mm-hmm. So debt to income, credit card payments, sometimes that monthly payment is really low compared to the full amount that you owe. Regarding tax returns, I highly suggest you come talk to me first before you go do your taxes. Because tax preparers, mom and pop shops, mm-hmm. the way they promote their business or the way they get more business is if they get you more money at the end of the year, right? So like a refund.
Yeah, tax refund.
And in order to get a tax refund, in most cases, you have to show a lot of losses, right? And if you show a lot of losses, then when I take a look at your tax returns, you might not qualify for the loan. So it's very important you come talk to me first so I can do the numbers for you, and then maybe even together we can talk to the tax preparer.
Got it. So, as you just heard Andy say, sometimes if you see him before you file your taxes, before you pay off that car, before you pay off those credit cards, he's going to be able to guide you on what to do specifically so that you can qualify. Because maybe you don't need to pay off that $15,000 credit card that you have. Maybe that's not the best option. Maybe you could use that to either buy down rates, things like that we're going to talk about in a bit. So, tell me, Andy, how does a mortgage work? I know that's a broad question, but kind of give us a little summary of how it works.
Yeah, so obviously, when you want to buy a house, there's a price to that house. If you have the cash, then good luck, then perfect. You're a perfect person.
We're not all that lucky.
Yeah, we're not all that lucky. So you would need a mortgage. And what a mortgage is just that price of that home based on a monthly payment divided in 30 years, right?
Okay.
So a bank, like the bank that I work for, would lend you the money for the term that you like. So I will give you terms of 30 years, 25, 20, 15, 10, if you like.
And is 30 the longest term?
There is a 40-year term, but it's...
And why is that not a common thing? Why do people not hear about that?
Because it's a non-traditional loan.
Okay.
It's starting to become traditional because it helps with the monthly payments, but not a lot of banks provide 40-year term loans.
Got it.
So then we give you a 30-year loan, and then we give you an interest rate. In that payment, in that monthly payment, we include your principal and interest, your taxes and your insurance, and then depending on your down payment in the program, we include also mortgage insurance. So all of that together is called PITI, principal, interest, taxes, and insurance. That's your payment.
Got it. And that was actually going to be my follow-up question. What is included in your payment? But you just answered that.
Yeah. So once again, just to touch on it, so it's your principal and interest. That goes directly to pay down your house. Then your taxes, which is here in Los Angeles County and in the broader part of Los Angeles County, it's purchase price times 1.25%. All right, don't quote me on that because there's other areas in LA County where it's a little higher with supplemental taxes, but
like here in San Fernando, taxes are higher.
Valencia, Palmdale,
yeah.
Lancaster, taxes are higher.
Yeah.
But just for the sake of argument,
Yeah,
purchase price times 1.25%. And then the mortgage insurance. The mortgage insurance, depending on which program we're going with, either FHA or conventional. So those four things give you your monthly payment. I must add that if you're buying a condominium, there is an HOA payment that's included in the condominium, and that would be the fifth item on your mortgage payment.
Got it. And you said mortgage insurance. Back earlier we were talking about not paying off certain things because of, there might be a better option, right? Is there a way to prepay for that? Or is it cheaper if you do that? Tell me a little bit about that.
Yeah, it's a great question. So if you're doing an FHA loan, you cannot prepay your mortgage insurance. You cannot, not with an FHA loan.
Okay.
But if we're doing a conventional loan, you can. So if you put 20% down on a conventional loan, you automatically do not have to have mortgage insurance. The bank will not give you mortgage insurance.
Okay.
But if you don't have that kind of money, you could actually buy a house with 5% down and then prepay the mortgage insurance. And then you won't have to worry about that monthly mortgage insurance payment, which does help you out, $250, $300, $400, especially here in LA County. It could be a nice savings a month.
Got it. And when a client comes to you, obviously there's a lot of requirements and things that you look at to see whether it's a better option for them to go conventional or FHA. But really, what are the main factors that you look at when making a decision with the client to be able to guide them on what's best for them?
Well, when I'm talking to a client, I hear them out. I hear their situation. I pay attention to how much money they want to spend. And then, of course, I run credit. Credit tells me, automatically, whether I'm going to have to go FHA or if I have the option of going conventional.
So which one's more lenient on credit?
On credit, I would have to say FHA.
Okay.
FHA, because with FHA, I mean, I've done loans down to 555 this year.
Wow.
Right?
So I mean, you just heard that. 555. A lot of people think they need a 700 and above to buy a house, but as Andy just said, obviously, hopefully you have a higher credit score than that. But again, even at a 555, he was able to push through this loan.
Yeah, and again, I don't want to break the internet saying that I just, I do loans at 555. That was a special client. But the minimum FICO score for an FHA in a broader sense is actually 580. 580 is it. But if you have equity in the property, we can go down to whatever the system allows you to go down at. In that case was 550.
Got it. Okay. Now, we're talking about credit score. Another one of my questions or misconceptions is, well, Andy, I don't want you to run my credit because it's going to hurt my score. Or I want to actually shop your interest rate. Can I go shop it around with a couple different lenders? Or how does that work? Will that hurt my credit score or will it not?
Yeah, so that question depends on what you are doing with your credit. So if you're shopping around just in the mortgage industry, right? Like if you come to me and then you're like, Andy, I didn't like him very much. Let me go to Chase or whatever. Mm-hmm. The credit bureaus actually allow you to do some shopping around. That way you can pick and choose as a consumer. But if you come to me and then you go to Honda and then you go to Macy's, you see that jumping around of credit?
Different types of different credit inquiries.
Exactly. That will definitely hurt you.
Got it.
There's other things that will hurt you too, meanwhile you're running your credit, but that's the difference of running your credit with one section of the credit bureaus, mortgages, mm-hmm. and jumping around.
And how long do people have?
When they run the credit?
Yeah, and let's say I've been shopping around for the last 2 years. You know, is that okay, or do I have to do it within 15 days, or what does the timeline look like?
Yeah, so when you're shopping around, hopefully you can, let's say, run your credit with me, and just for the sake of argument, Bank of America, and that pre-qualification is good for 60 days.
Okay.
60 days. After that, I would give it another month before shopping around again, to rerun your credit. But that would be the timeline of your pre-qual, 60 days.
Got it. Actually, you answered another one of my questions. Okay, perfect. Now, what's the difference between, for example, what is the bank that you work for? What is that considered? Is that a direct lender? Is that a mortgage broker? Or is it the same as a Wells Fargo, Chase, a Bank of America? What's the difference, and how do you differentiate yourself from all of those?
So mortgage management consultants, MMC Lending, we are a non-depository bank. What I mean by that is you can't come in with your $50 and deposit it into MMC Lending in our teller. We don't do that. But we are a bank. We finance properties with our own credit lines. Now, the difference between us and a lot of mid-sized banks, right? We all understand what bigger banks are. Bank of America, Chase, those are, we all know what they do. But I like the bank where I work because we also sell directly to Fannie Mae. Mm-hmm. Fannie Mae is the 700-pound gorilla, Fannie Mae and Freddie Mac.
Yeah.
They are lending. So we are selling directly to them, and we service loans directly to Fannie Mae and Ginnie Mae. So
there's three: Freddie Mac, Fannie Mae, and Ginnie Mae.
And Ginnie Mae, yeah. So it kind of answers the other question, the mortgage broker question. What is a mortgage broker? So mortgage brokers, what they do is they don't lend you money with their funds. They shop around for different banks to be able to provide you your loan, which I think is good too because they have different options. Mm-hmm. But the problem is that sometimes it's hard to have that really good relationship with underwriting, processing, your funders. It's hard to do that, right? Whereas, and then with the big banks, they're really tight with their guidelines. super tight. Like,
Got it.
there's there's banks that don't want to go down certain FICO score.
Basically, you have to be A paper. You have to be a perfect client,
Yeah.
and then they'll give you a loan.
Yeah, and what I like about MMC lending is that I'm kind of a one place shop of both sides of the big bank, because we are a bank, and the broker side, because I kind of work like a broker. I'm not salary based. I'm commission based, so I have to hustle on the weekends and at night and stuff like that. I have to run around with the clients, going with them to the bank and to help them with their tax returns and everything like that.
Yeah.
Why? Is because I work like a broker. If I don't help the client that way, then I don't get a commission.
Got it. Makes sense. Now, going back to the buyers, right? How do down payment assistance programs work? And is that something that you suggest to every client? Or tell me a little bit about that.
Yeah, so down payment assistance has definitely come through for a lot of our clients. And the way they work, and I'm just going to say it very simply, is let's just give an example. If a client was to get a 7% interest rate or a 6.5% interest rate, down payment assistance would increase their interest rate to 7.5. That 7.5 pays the bank a premium, right? It's called a rebate. And the third party company that we're using for the down payment assistance gives that to the client. Right? So that's why in most cases, I'm going to say, the interest rate is a lot higher on down payment assistance than on regular loans. Not everybody requires down payment assistance. Not everybody needs it. I'll give an example. I had a father of 5. It was just him and his 5 children. And it was very hard for him to save money. 5 kids, diapers, food, everything.
Yeah.
But he can make the mortgage payment. So I told him, I said, look, let's try one of our 3 down payment assistance products. And he's super happy because we were able to provide him his down payment. He makes the mortgage payment. And actually very soon he's going to refinance out of the down payment assistance so we could get rid of that program and lower his payment.
Got it. So as you just heard Andy, I think it's catered to every different client, right? He builds either the program or how much down payment or whether you're gonna need down payment assistance. He builds it for each different client. Now, Andy, can somebody with only an ITIN number get a loan?
Yes, they can.
And is it 30%, 40%, 50%? Crazy numbers like that?
It depends which bank you go with. Some banks do it with 25. Some banks do it with 20. There are banks that do it with 5% or 3% down. There's banks that do that. And of course, when you come over and you do your pre-qualification, I will guide you. Even if I don't have that loan product that you need, I will definitely tell you where to get it. But you definitely can buy with an ITIN number.
Beautiful. Now, if a client owns a home, can they still be considered a first-time home buyer?
Yeah, so it depends which product we're using. So if we're using, and I'm just going to name the product, if you're using a CalHFA down payment assistance product, then that answer is no, because they want you to not have owned a home in the last 3 years. Okay. But if you're using any other down payment assistance product, we have Chenoa, we have Arrive, and we have GSFA. They allow you to have another home and purchase another property with their down payment assistance product.
Wow.
On a conventional loan and FHA loan, they have different guidelines, but you can own a home and you can buy another home with minimum down payment. The key is that the underwriter has to believe you that you're going to occupy that property, that you're going to live in it. If we can convince the underwriter that that's a fact, then you can go with minimum down payment.
So most of the times it has to be bigger, better, something adding to your lifestyle, right?
Yeah.
You're not going to go from a 4-bedroom to a tiny 1-bedroom house.
Exactly.
Okay.
Exactly. Or you're not going to buy, if you have this 4-bedroom house, you're not going to go into a condo.
Understood.
Into a condo. There are certain situations where you can buy down, purchase down, and that would be a downsizing. And that would be if you're getting up there with age.
Empty nester.
Yeah.
You don't have anybody living with you anymore. It's you and your wife.
Yes. Yeah, I mean, if you're, you're 65 and older and you're having a hard time cleaning the house or cleaning the pool, and it's a 4-bedroom house and your kids left, like you said, empty nester, then you can definitely buy down, because the underwriter does understand that you can't take care of this big old home.
Got it. Okay. Now, another question. Let's say a lot of people say, I want to save up 3.5%, or I want to save up 5%, I want to save up 20%. Do you suggest, again, I'm an advocate of once you just have the thought that you're possibly going to look to purchase a property, sit down with the lender so that you can, again, be guided to the ultimate goal, which is actually purchasing a property, right? Is that something that you suggest? Because a lot of people want to say, well, I don't have the money. Why would I even sit down with Andy yet?
Yeah, so if you think the last sentence you just mentioned, but you want to buy, you definitely should sit down with me, because like I said, we just talked about the down payment assistance products that we have, that can cover your down payment. Okay. Now, if you're also a client that has saved up money, you've saved up your 5, your 10, your 20% down, it's important that you tell me how much money you have, not because I'm gonna just blow it and use all your money. I don't want to do that. Oh,
perfect. Let's use that.
Yeah, exactly. No. What I want to do is I want to give you options. I want to say, okay, you came in with the intention of putting 20% down. That's great. It makes my life easier. But here's the 5% option. Here's the 10% option. And why not let's buy the PMI. So doing that, 5% buying the PMI might actually fit in within your budget, and you won't have to use your 20%. Does that make sense?
Got it. But if you don't have money to do with things, change things to the property, have some reserves.
Yeah. But if you don't tell me you have that money, then I'm just gonna go and say let's do this. So my job is to give you options.
Perfect. Now, in terms of options, for a while, lenders were paying for closing costs, things like that. Is that still a thing?
No. Right now, the lender credits have been a thing of the past. I'm sure it'll come back. Because the market has a short-term memory. It all goes in a circle, so it'll come back. But as of right now, lender credits they're not happening right now.
Okay, got it. Now, when in the process should a client consider refinancing?
Whenever they have a savings, that's when they should refinance. Unless you have one of these, crazy products where they make you refinance. But if that's not the case, whenever you're saving money, I'll give you my example of my house. So I purchased my house in 2012. I had really bad credit, as I'm a lender, and I had really bad credit, right? So I bought with FHA. My interest rate at that point was 5.875. A year later, I dropped it to 4.5, and I still had to go FHA because just issues. You know what I mean? So it took me a while. It took me, I think, like 3 years to be able to switch it over to a conventional loan. So I actually refinanced my house 3 different times, but I only did it to drop my payment if I had a savings. So I went from 5.875 to, I think I have a 3.25 now, conventional. So I took off the PMI and I dropped my interest rate. And that would be the perfect time for you to refinance anytime you can save money.
Got it. Makes sense. Now, how long does it take for a lender like yourself right now on average to close a loan?
I mean, we're not that busy. For example, I submitted a file yesterday. This LAPD officer, I submitted her yesterday in the morning, and we got the approval in the evening. So it took me, less than 24 hours to get you an approval. But every closing is different. Some clients are super clean, and we can close in about 20 days, 25 days. And there are some clients that require a lot of help. And I do both. I do both sides. I will, go up to bat for you, whatever type of client you are. But it just depends what kind of client it is.
Got it. Now, what is a 203K loan? And what are other alternatives to this loan? And is this something that you suggest?
Yeah. So a 203K loan is a construction loan through the FHA, through HUD. So
So it's an FHA loan.
it's an FHA loan, yes. And we will give you money to do construction on your house. Now, there's two types of 203Ks. There's a 203K Streamline, and there's a 203K regular, they call it. So 203K Streamline is up to $30,000 of cosmetic repairs. So paint, flooring, cosmetic stuff.
Mm-hmm.
Now, if you want to, add another unit, or you want to expand your house or build a pool, then we have to do the 203K regular. And both of those loans require a contractor. Obviously, they require permits.
Licensed contractor?
Yes, a licensed, vetted, bonded
Okay.
contractor. You can't use your Tío Pablo and stuff. You
Yeah,
can't,
Tío Pablo.
unless he's licensed and bonded and insured. Another option to the 203K is a home style renovation, and I'm actually doing that one quite a bit. The home style renovation.
And that's not FHA.
That is not an FHA loan. That's a conventional loan.
Okay.
And the home style renovation again is a construction loan. Whatever you want, whatever you're thinking about doing to your house, you can pay with a home style renovation, as long as the future value of that home covers it. So let's say you buy a house here in Pacoima for $480,000 because it's just junk, but the future value of the home is $700,000. That means you can actually get $180 or whatever $1,000 to make that home look like what you want it to look.
So there's no limit, as long as that after making the repairs, $200,000 worth of repairs, it's worth at least those $200,000.
So the max loan to value for this loan is 95% of the future value of the home.
Oh wow.
Yeah, so that's pretty cool. 95% of the future value of the home. I like it. I used it for a flip that I did in the La Brea area a couple years ago. It's pretty good. And one of the things that we're doing right now is that the state of California has a grant of $40,000 to people that are building ADUs.
And what is a grant?
A grant is money. It's basically money. It's not a loan. It's money that the state is giving you for
Free money.
Free money.
You don't have to pay it back.
You don't have to pay it back, as long as you do what you say that the state wants you to do, which in this case is building an ADU. So
I don't know if you guys heard that. $40,000 free money from the state that you can use. So what's the catch?
So not really a catch. I mean, if you're building an ADU, so an auxiliary dwelling unit, right, which is like a duplex, but it's not a duplex, right?
It's that weird place that we're at right now.
Yeah, we're in that weird place right now. So if you build an ADU, of course, you have to have the permits and the money through Homestyle Renovation. We fill out an application with the state of California. We show them that you've built an ADU. We show them how you financed it. And if you make less than $168,000 and you've met all the requirements, then they will give you $40,000 directly into your mortgage. So in the example that I gave you, if you did a $480,000 loan, you got $100,000 to build this ADU, you now owe $580 to me or to MMC. The state credits you $40,000. Now you owe me $540 instead of $580, which is pretty neat.
Got it. Wow.
Yeah.
That is pretty cool. I mean, and these are all programs that a lot of people aren't aware of, right?
Yeah, you have to be approved with CalHFA.
So is there education that needs to be done, or
for both of us, for myself and for the buyer too? They need to do an 8-hour course through CalHFA, and then the bank that you're working with has to be approved through them in order to be able to get you this grant.
Got it. And does it matter whether it's an FHA loan, a conventional loan? There's other stuff like a HELOC loan, stuff like that. Do all of those qualify for that?
So we're talking about the 40K grant, and that answer is very broad. Okay, so definitely the conventional loan works with the grant if you're doing a home style renovation with us. right?
Got it.
With an FHA loan, you can get the grant, but the ADU has to be attached to the house. If it's detached, then the federal government doesn't consider it, or the state of California doesn't consider it an ADU. I don't understand why. So
sounds to me there's a lot of conflicting guidelines between
yeah,
states and all these programs, stuff like that.
And a lot of people don't know that you can actually qualify for the 40K with an FHA loan, and I figured it out. The only thing is that the ADU has to be attached.
So like converting a garage or stuff like that, that's considered an ADU.
Mm-hmm.
Got it.
Yeah, and then if you want to do a HELOC and build an ADU, that gets super complicated. But I figured that out too. There's a third party company approved by CalDRE by the name of HPP Cares. So you just have to submit an application. They're super overwhelmed right now because that's the only place in California right now that's approved to do this. So you submit an application and you show them what you're doing. You send them your tax returns, your bank statements, how you're paying for the ADU, and then they submit that application directly to CalDRE. And if you met all the requirements, you'll get your 40K.
Wow. So we're talking about HELOC loans. What is a HELOC loan?
So a HELOC stands for Home Equity Line of Credit. And the easiest way that I always explain it, it's kind of like having a credit card. Mm-hmm. So it's like a nice fat credit card attached to your home. So it's it's a second mortgage.
So it has nothing to do with your first.
Nothing to do with your first.
You're not refinancing.
You're not refinancing your first, but you are tapping into the equity of your home.
Got it.
I have a HELOC, so we didn't touch my first. I have a second mortgage, and I make payments depending on how much money I'm using. So I have a HELOC for $150,000. If I don't pull out $150,000, then I don't make the full payment. I can pull out $5,000 and my payment's like, I don't know, $100 or less. So it's just like a credit
payment
card.
goes up and down based off of how much you're using.
Yeah, and if
and if you pay it all back, and there's no payment.
No, there's no payment.
And how often can you tap into it? Does it ever go away?
It does go away because it has a term.
Okay.
It depends where you go. We do HELOCs, but I prefer credit union HELOCs, and those are they do that pretty well actually. Credit unions, and they have a 15-year term and they have a 20-year term. So I have a 20-year term HELOC. So I got it maybe like 5 years ago. So I have another 15 years that I can use my HELOC. Mm-hmm. There's gonna come a time when the 20 years hit that I have to make sure that I paid off the HELOC. Or else they want.
It's like balloon payment kind of thing at the end?
Yeah.
Got it. And what are interest rates on that? Are they similar to conventional FHA, or what are we looking at?
So, yes, they are, because they go at Fed rate plus margin, right? So I think the interest rates right now for the HELOCs are like in the mid sixes, 6.5, 6.25. But what's pretty cool is that they have what do they call it? Promotional interest rates, where you can go in there and for the first 12 months your rate will be like 3.5 or 3.25 at some of these credit unions, and it's just promotional, and then it goes back up to the 6.25 or 6.5. I like my HELOC. I use it quite a bit whenever I need it.
Got it. So that brings up another question: should people lock in a HELOC loan when interest rates go down again, just to have access to that equity?
Absolutely,
if needed.
Yeah, because it's cheaper money. You're borrowing money at a cheaper rate. You're gonna pay less interest if you do that. Anytime rates drop, it's always a good idea to refinance your home if it makes sense. All right, and of course I'll tell you if it makes sense for you. But definitely, if interest rates drop, it's a great idea to get a HELOC, because then they can come to you and purchase a home, with 10% down, 5%
investment 5%. Property, or something better for them, for their family, things like that.
Absolutely.
Okay. Now, I know that there's a lot of talk right now about the 3-2-1 buy down. What is that? What are the pros, the cons? And why is it that is more appealing to somebody right now than a variable interest rate loan?
I really like the 3-2-1 buy down because first of all, the money to bring down the interest rate for those first 3 years comes from the seller. It doesn't come from the buyer. So the buyer,
Can it come from the buyer?
no, it has to come from the seller
Interesting.
for a 3-2-1 buy down. So first, I'm going to explain what it is. So as we know, interest rates have climbed quite a bit. If you pre-qualified yourself with me in January through May, interest rates were at 3.25%, 3.5%. Right now we're at 7%, right? 7.125%. That's a huge jump.
Yeah.
Right. And some of our buyers are like, I can't do that. I can, but it's really, really tight.
Yeah.
Right. So this product, what it does is it buys down that interest rate for the first 3 years of the loan. So on the example that I just gave you with the 7%, if we were to do a 3-2-1 buy down, on the first year of the mortgage payment, that interest rate would be from 7% to 4% for 12 months. The next year, from 7% to 5% for 12 months. And then the third year, from 7% to 6% for 12 months. It's a huge savings. I've had clients right now that are saving $1,100 every month for the first 12 months.
Got it.
That's ridiculous. And then again, the money comes from the seller. Now, why the 3-2-1 buy down right now? Well, because a lot of sellers are actually bringing down the price of the homes. So, if they were listing it for $800,000 and now it's listed for $750,000, you actually save more money on a monthly basis if you do the 3-2-1 buy down instead of dropping the price.
Wow.
Yeah.
You bring up a great point. So now, why is that better than an adjustable loan?
Well,
or not better? What are the differences?
Yeah. So the thing about adjustable loans, I'm not against them. I just you have to be careful with the type of work that client is doing. Like for example, if you're a licensed attorney and you work for this great firm, and that firm is just solid, it's not gonna go anywhere, and you're salaried, then you're pretty safe in getting an adjustable loan, and you move it around ever so often. But if you work as a construction worker, and your money's going up and down, or you have your own business, you never know how your income is going to be. So sometimes it's better for you, because you're that type of client, to get a longer fixed term. It doesn't have to be 30 years. It can be 15, 20, 25, 30. Of course, the rate is higher, but it's safer.
So it's higher the longer you go on term of loan?
Yeah.
So on a 10-year, 15-year loan, it's a smaller interest rate.
It's a lower interest rate, yeah, but it's safer. So I will have, the buyer does want to have that conversation about adjustable loans. I definitely will give that option, and then I also too I will give them my opinion as to what I think is better for them. But again, it's the buyer's option to see what route they want to take.
Got it. Now, this is actually one of my last questions here. What are some misconceptions you see that many clients have that we haven't covered already?
I mean, I think you covered all of them, but the main one is a lot of clients tell me, I didn't think I can do this. I didn't think I could afford this house. I didn't think I had the money. Or the other one is, I didn't know how to get things going. And the thing is, all you got to do is just pick up your phone, shoot us a text, an email, and get the ball rolling.
So really, it's just getting started.
Yeah,
taking that first step towards your goal.
Yeah, because how much time do you want to live with your parents? How much time do you want to rent? How much time?
So the way I say it is, look, at the end, the worst thing that could happen is we say at this moment, you don't qualify to purchase a property here in the area. Now, this is what you need to do to prepare yourself to get to that point, right?
Absolutely, yeah.
But if they never have that conversation with you or with us, they're not going to get there.
Yeah, exactly. You know, we're kind of sort of like a coach. You know, we draw the game plan on the board. We tell you, you know, you're going to take this route or you're going to take this route, and if you follow the route, at the end of the day, you're gonna score a touchdown. As long as we all work together as a team with a common goal, we'll help the client get a home.
Perfect. Anything else you would like to add?
No, just take the first step. Give Jerry a text. Shoot him a call. Shoot him an email. We all work basically seven days out of the week, so we're available on the weekends and at nights, and we're very eager to help you out.
Beautiful. Now, actually, I'm going to end with 5 quick questions. How many co-signers can be on one loan?
In FHA, you can have 5. In conventional, you can have 4.
Perfect. With all the necessary documents, how long does it get to get pre-qualified?
It should take me about no more than 24 hours, depending how busy I am. I am blessed in having 2 good assistants. So if I can't handle it in 24 hours, I shoot them off to them. But I really try to get you an answer within 24 hours.
Got it. Perfect. Now, how long is a pre-qual letter good for? You said it earlier, but let's repeat that again.
60 days, and then if you don't move, I don't mean to say no move, but if you don't touch your credit, if you don't go buy cars, if you don't go co-sign for stuff, I could extend it a little longer. So once you get pre-qualified, just don't use your credit, and then we could extend that pre-qualification for a longer term.
Actually, that was my next question. Can I buy a house, get another credit card, or rack up my credit cards during the process?
Yeah, if you're getting pre-qualified and you want to buy a house, don't do that. That's
Don't do that.
You'd be surprised. You'd actually be surprised how many people they don't think that co-signing hurts their purchase, but it does. If you co-sign for your primo, your uncle, your dad, it hurts your purchase. Also, too, if you go buy a refrigerator or anything like that during your purchase process, it will hurt your purchase. So once you get pre-qualified,
don't do anything.
Don't do anything. And
don't touch it.
And if you are thinking about doing it, tell me. So
ask before you do anything.
Yeah, ask me.
Even paying off stuff, ask before you do anything.
Yeah,
has to be from the right accounts. Has to be there has to be an explanation.
Yeah.
Later on you're gonna get a call from Manny. Why'd you do this?
Yeah.
We don't want those calls. Let's make sure that we ask before doing any of that.
Yeah, and let me give you an example of somebody that had to do that. I have a client right now who has a $800 car payment, right? And he told me, he said, Andy, can I sell? He's in the car industry, and he said, could I sell my car and get another car? So I said, what's the new car payment? And he said $350. And I said, absolutely, because your pre-qualification is super tight. So if you do this, and this, it's actually going to help your pre-qualification.
Got it.
So in some cases it does work, but in most cases, do not buy anything, please.
Ask before. Ask your lender before you do anything. And last question: carne en su jugo or pupusas? Choose one.
Dang. Okay. You know what? My suegra makes bomb pupusas, bro. Like bomb.
Oh man.
Yeah, dude. That's how she got me for my wife, bro, with pupusas. So I'm gonna have to say pupusas.
Oh, pupusas.
Yeah.
Well, I'm a carne en su jugo kind of guy. That's actually my favorite meal. My mom and my grandma get down.
Oh man.
But I just want to thank you, for taking the time. Obviously, this will be able to answer a lot of questions that some people out there have. Hopefully, those of you that are watching, we've answered your questions. If you have any other questions, I'm going to be doing this exact same format with an escrow officer, NHD, home warranty, title, and actually with my dad, which is my broker. Going to be asking him about different misconceptions, how to avoid lawsuits, a bunch of whole different things. He's been in the business for about 40 some years. And like I said, if there's anything else that you guys would like to hear, little snippets like this, let me know. I'll make sure to record it. Maybe we might bring back Andy. But these are a lot of the questions that I've heard from my clients, from people that I know, and sometimes even from agents that don't know these questions. But hopefully this answered a lot for you guys.
Hopefully. Thank you.
Thank you. Signing out, and until next time.